You built the practice. You served the clients. You cared for the patients. You hired the team. You carried all the decisions, the pressures, the growth, the problems, all of it. And then one day, you start wondering what the business is actually worth. Most veterinary practice owners spend decades building a business only to realize at the finish line that they've built a high-paying job, not a transferable asset. If your clinic can't survive a week without you at the helm, you aren't just exhausted, you are likely leaving millions of dollars in valuation on the table. Welcome back to the Veterinary Business Podcast. I'm your host, Don Adeesha, and it's great to have you here. To help us bridge the gap between running a clinic and owning a scalable business, we are joined by Muriel Touati. Muriel is the founder and CEO of Exit 3D Studio. She is a renowned authority on exit readiness, specializing in helping service-based founders move away from the daily grind to create structured, visible, and high profitable businesses that buyers crave. Today, we are discussing what truly drives practice valuation just beyond revenue. We are talking about the owner dependency trap and how to optimize your digital and operational systems to maximize your eventual exit. And of course, this episode is brought to you by Echo Marketing, the team helping veterinary practice owners elevate their online presence and grow with clarity. With that being said, Muriel, it's great to have you on the podcast.
Thank you, Don. I'm really happy to be here today.
So, Muriel, from a buyer's perspective, what makes a veterinary practice owner more valuable than just its revenue or profitability?
Yes, good questions. So this, I would say, it's the predictability and the fact that if the owner were to leave, the new owner could just run the business just as it was before. That means a business, veterinary practice that is transferable, meaning everything has been documented, not everything is dependent on the owner. And so this is the most valuable. This is what a buyer will value and pay more for. A business that really transfer.
Absolutely. Now, you actually spoken about a hub and spoke example.
Yes, sure. But for example, if I think about my framework that apply to all type of service businesses, there are some questions that a buyer will ask and will price. Those are, for example, is the revenue concentrated? So an example in a vet practice, that will be, does the revenue come just from one referral source that the owner own? For example, you might have another vet practice that just sends you client. Like it is one channel and one source. This is not sure that it will transfer with the new owner. So this is an important question to ask at the beginning. Like, is the revenue concentrated that way, like from one channel, or does it come just from some loyal clients that come all the time? Because the question is, if one or two relationships walk out the door, does the revenue drop significantly or not? And usually what buyer will really flag, it's customers that do like 15 and above, even from 10% and above, because imagine this. If tomorrow you sell your vet practice and that relationship doesn't transfer to the new owner, that's directly 10% or 20 or 40% of the revenue that will disappear. You know, when the revenue is concentrated, it's always a risk for a buyer, and this is something that they will discount automatically. Usually with I will say a holdback or an earnout, saying, you know, the purchase price. Let's say that the practice is the owner asked for $2 million for their practice, but the revenue is concentrated 40%. Well, most likely let's say that the buyer say, okay, I offer $2 million, then the terms might include and will more certainly include some seller notes, some like even forgivable seller notes, saying if the revenue stay, let's say $1 million for 1 year, then you get your 40% seller note then, because we've been able to retain the clients. And if not, let's say the revenue dropped 20% or even the full 40%, then the 40% seller note could just be forgiven. Then that means never paid.
That's right.
So yeah, really the transferability of the relationship, and avoiding the customer concentration, revenue concentration is very important when you're thinking to sell a business.
Check. Now, tell us, what are the most common valuation mistakes veterinary practice owners make before they sell, or actually before they decide even to sell or transition?
So one of the mistake will be, okay, to price, there are several, but I'm thinking of one, is to price the future upside in the asking price. Saying, for example, the practice have a 500K EBITDA. They want a 6 multiple. Okay, so they want $3 million for that. But that include, because they say, oh, but next year they're going to build a mall next to my practice. There will be more traffic. And in 2 years, they could open another location right there. And they could also be doing this or that online. And okay, those are upside for the buyers, not for the sellers, because the sellers should be implementing all of that to get the $3 million. Asking price. If the buyer has to be doing all of that, then the upside should be for him. And so the asking price should be lower. And I think this is one of the reasons why so many businesses that go for sales never sell.
Okay.
There are some official, statistic. I think it's from the Exit Planning Institute, I believe, who say that like 70 to 80% of businesses that go for sale, all industry, never sell. And I think this is one of the issue, the asking for too much. And, but yeah, there are other structural issues. Maybe we'll get there as well.
Okay.
Yeah.
So basically, because just to recap that point, what you're basing your valuation on is something of a forecast. It hasn't really happened yet, right? Your hope, or is it something else?
Yeah,
Okay.
no. It's we based the valuation on the past 3 years of
That's right.
revenue. Yeah, plus the trailing 12 months. So
Right.
basically, we need to look at 3, 4 years past, depending where we are in the year for the TTM. But this is what we're looking at. And for buyers that intend to get a loan to buy the business, I think most of the time, the lenders is going to go, more deeper than that. It's not just going to look at the 3 years. Actually, it's going to take into account the worst year, because the worst year of the last 3 years, because if the revenue can drop that much, that means that in the future it can drop again. So this is what they take into account. And then different calculations are made with the buyer also profile and information to come to a DSCR number. It's the debt ratio, like if it's 0.5, forget it. It will never get the loan. It needs to be at least 1.25, and the higher, the better. That means that the lender will be confident that the buyer can repay his loan with the business, as he operates and how he has been operating in the past. We don't
That's right.
look at the future. That's why it's
At all.
yeah. We
Is
assume
it?
that things will continue in the same trends, basically. Yeah.
That's right. Yeah, unless there is a major catastrophe like COVID or something like that,
Yeah,
they're
yeah.
going
And
to.
now we think about this. We think also about, AI disruption and,
Oh,
yeah. But fortunately, I think for vet practice, we're good. There should not be
yes.
too much AI disruption. So, yeah. So,
Yeah, until the
stay.
robots come and take over all the technical jobs, but that's a conversation for another time.
Yeah,
So
yeah.
definitely, one of the biggest mistakes that means you are seeing is perhaps is not correctly understanding valuation from the seller's point of view, right? They're expecting perhaps their future is going to look brighter than their past, but when the reality, from the buyer's perspective, they have to think about taking the loan. And when we look at the loan lender's perspective, they're looking at, is it possible for me to recover this amount of money if I lend it? And to do that, they need hard facts. Even on a worst year, they can somehow repay it if they do have the correct DER. I mean,
Yeah.
that's a,
And
yeah,
that's
go
why
ahead.
it's important to prepare years before a sale, not
Mm,
6 months before. 6 months before, you can make the financial look good, adding, a lot of add backs and, make a little fluff to increase the
mm.
EBITDA. Okay. Yeah. And the valuation. But all
What
of
are
this will be.
those fluffy things you think like within 6 months that can actually make it
Yeah,
look
well,
better?
it's I think it's the work they will do with their business broker, for example. Okay, so now increase the valuation. So, okay, they will ask, have you done any trips that you want to add as personal trips, for example?
Mm,
If they took a vacation with the family, this could come as an add back, saying, okay, I spent that money with my family. It was personal, but I put it on as a business expense, and
mm.
you, the buyer, will not make that expense. So it should. This is money that I'm adding back. In the business, basically, they're not doing it. They're not really transferring back the money on the account, but they rate it so it appears on the financials. And some other things like the restaurant bills, or so this is a way that how they prepare 6 months in advance. But this is always dismantled by buyers and lenders. So it's almost not necessary to do that. some are, really legitimate, and they should
Yeah.
be. Like, for example, if the veterinarian is getting an above the market salary,
Mm-mm,
then
mm-mm,
okay, that difference we could put it at back for sure.
mm.
This is legitimate. To also his own insurance, or you know, even everything is related to cars, also like his personal car, and can be as an add back. Yeah.
Mm. But those are very minor things just to make it look a little bit better. Once, a decision is going in a more positive direction, because I don't think like, correct me if I'm wrong, having these add backs, the differential between the owner vet, above market pay or their vacation time would, be the deal breaker, or rather even the deal maker, right?
No,
For
it's
deciding on.
yeah, it's not a deal breaker. I think it's part of the game. Let's say, like, they should be doing it because why not?
That's that's right.
But then they need to be open to the fact that not everything is going to be accepted. A
Mm,
lot are going to be, this is not acceptable, this is not, and just to normalize the EBITDA that way.
mm. Right. So it's really a more of a good faith kind of gesture, really, on top of an already solid transferable asset.
Yes, and if something that's worth mentioning is when a buyer make an offer, after that is doing a very in-depth due diligence and is checking
Mm,
everything, including
mm.
all those add backs. Like everything needs to be justified. So it's
Of
more than
course.
just good faith. It's really, yeah. Is it something that they can do or not do? Because some are accepted, some at back are accepted. It's legit to be adding them back, and some are not.
Okay. Okay. So it's really more of a transparency conversation right there. And of course, when the buyer is doing the due diligence, they expect all of these things to be there. If it's not, then that might be a bit of a deal breaker, right? Because, they're trying to, I don't know, are they hiding something, or are they just inconsistent with what they're saying? Are those deal
Yeah.
breaker signals?
Oh yeah. I mean, deal breaker signal. There can be many. Let's say that they really want to push an expense as a
Mm,
personal expense while it's not. Sometimes we see it with marketing or advertising trying. Let's say they spend 20,000, but it didn't work. Okay, well, that's still a business expense. You cannot add it back. Let's say they don't want, there's a struggle there. Yeah, it can be a deal breaker. Just like when we check how recurring are the revenue, and if we find out something that is that doesn't show the that I just want to give you another example. Last end of last year, I had an offer accepted for an agency, and this is exactly what I bumped into. They were marketing the agency as a recurring revenue. But when I did my research and I looked at the revenue per client over the past year, each month, which client, I was able to see that, okay, last August they had 35 clients. Funny that
mm,
in December they still have 35 clients. If actually they bring on, I don't know, 30% more of client every month, let's say 10 new clients per month. Why
mm,
is it
mm.
always the same number? Oh, and same last February, still 30, 35. And then you analyze all of that. And I was able to see that it was not recurring revenue. It was like rollover revenue. Every 3 months, okay, they were getting 10 new clients per month, but every month they were losing 10 clients. So this was more of a rollover type of revenue than truly recurring. Recurring happen all the time. It does not, 3 months is almost a project, you know?
Yeah,
So this is an example of other deal breaker.
absolutely. When you don't have that recurring revenue, or even that almost seems like a false marketing, right? Because
Yes,
you're saying,
yeah. And
yeah,
this
and that's
this happened a lot, unfortunately. But after,
that's
when
right.
I say deal breaker, it's okay. Before being a
Mm.
deal breaker, it's a renegotiation. There,
Mm.
buyer and seller. Buyer is going to try to negotiate, and possibly, like discount it, like decreases offer. Consequently, saying, oh, because this is not recurring, or because nothing is documented, or
Mhm.
because revenue is concentrated and you did not disclose that before. Well, now that I know, I need to tell you that your practice, to me, it doesn't worth $2 million anymore. It worth more like 1.2 million. So I can make that offer. Plus, I want to add this forgivable seller note for that part because of the concentration, and so they will present that again. And if the seller agree to the discount, then it's not a deal breaker. They can, get to the purchase agreement and get the deal done. But if there is some struggle, and the seller don't want that, or the buyer is just not confident anymore, like say, wow, I've been just lied to and I cannot cope. Let's say he was looking for like an a veterinary practice that is not founder dependent, for example, and realize it is founder dependent, and instead of buying a business, he'll be buying himself a job. If it is a deal breaker for the buyer, yeah, then yes, the deal will not happen at all.
Now, the reason why I was a bit excited about that dependency factor is I really wanted to ask a bit of a follow-up question, because now we have seen the problem, owner dependency, and how that may. So, break it down for us, Muriel. How does the owner dependency affect the value of a veterinary clinic, especially when clients are strongly attached to the founder or lead doctor? And of course, how can we fix that?
Sorry, I just want to make sure I understood fully the question. The beginning of the question, can you just say it again?
How does owner dependency affect the value of veterinary clinic, as we were
Yes.
talking about?
Okay, I got it. Yeah. So it affects the valuation because anything that is founder dependent, should that be the sales
Mm.
or the operation or the
Mm-hmm.
decision making, all of
Right.
that, if we need the founder um, to run the business, if we take out the founder for 90 days or even 1 week and nothing happened, the business collapse, well, this affects the valuation for sure.
Check. And then how can we fix that? That's the most important part.
Yes, so we can fix that by, for example, if the founder is taking all the decision, maybe he can start delegating that a little bit to
Mm.
other vet in the practice, saying, okay, for normal practice, this assume it's always a yes, this assume we always do that. Just having some sort of systemized decision making on a, and I am pretty sure that for a lot of the decision, from their training, and like they know what they need to be doing. But I will say if there are still some decisions that need to be taken systematically by the founder, then maybe see how we can delegate that. Another way will be to document everything that is done. Everything
Mm-hmm.
that is documented in SOP, for example, standard operating procedure, everything that is documented is very valuable, because this means somebody can read it, read the manual, the instruction, and know what to do exactly the way the founder will do it. So this is
Mm-hmm.
one of the way to reduce founder dependency internally.
Right. Now, when it comes to creation of SOPs and documentation, it takes a bit of time, especially if the procedure is done, if it has been refined to the point where for the owner, they know exactly what to do, but there's a lot of key processes and thoughts behind it, right? And to really document that onto paper is pretty difficult. What do you have to say to a practice owner who is facing that dilemma? How can they begin?
Yes, sure. Well, I would say that an SOP in any format, first of all, is sufficient. If you prefer to leave like a voice note on his phone, eventually once you do the voice note, he can just send it to AI that will create the SOP for him or her. He can record a video. It doesn't have to be a long time sitting. It can be on the go. Or we can
Mm.
have even better, if he has an assistant, he can
Mhm.
just, who knows the different tasks. He or she can document everything for the founder. So it can be delegated, or just take your phone or AI, just talk, and it will create a comprehensive SOP. Yeah.
Check. What a great way to start using AI. But more so, I really appreciated getting the help of your assistant in a bit more different way to help you create these SOPs. Because otherwise, it seems like something you have to do by yourself. And
No.
then you might be having some tough time figuring out a time to dedicate towards this documentation process. So, I mean, it's all of this valuation talk, right? I also have one last question for you regarding this particular dependency. For a founder who is also the lead surgeon, what is the transition period a buyer usually demands if the owner is the primary revenue driver?
So first of all, I think there is two questions in your question. If he's
That's
the lead surgeon, um, it's it's important to bring someone in, or at least like what does he agree to a future discount, because the buyer will
the
need.
lead surgeon is also the owner.
Yeah, it's what I understand. Yeah. There is two things. It's either you continue, as it is, and you accept a multiple of two, maybe three,
Mhm.
maybe less. Or
Okay.
if he aim for really a good multiple for his valuation, like a 4, a 6, or even more,
Mm.
there is two different way. But in the first way, just continue, and he will try to find a buyer operator, someone that
Mm.
will have the same capability than him, and just replace him. Like the buyer will just be the future lead surgeon. Or
Mhm.
if he wants a higher valuation, then he need to replace himself in the practice. Maybe
Mhm.
if he has some other, uh, you know, either he can bring on another lead surgeon that will be an employee in the practice. That could be the future lead surgeon for the future buyer.
Right.
Okay, so that's the situation in terms of operation. And for the sales, same. It depends how the sales are handled. But if it's only come from referral, let's say that the founder is networking, is going in different events. This is how he give his card to potential client, and they know him and they want to work with him. Okay, that's not the best way. So he needs to find a way to have some systematized lead generation and sales. And there is different way. I mean, he could hire a salesperson or have a team that do that. He can make a better use of digital marketing to be present on all the main platform where we can book online a meeting for for dog, the cat. I assume there are some platform for that on their website as well, having the direct booking, and then bring some traffic to those platform and websites with different. There are different way. I think for a vet practice, I like Google My Business. It's just online. You search, you appear, you're on Google Map. That's the number one way, I think. With good
Absolutely.
reviews. It's important to ask the reviews.
Of course, because if you have negative reviews, that's a bit of a turn off on the other side. But then again, maybe it might be a signal for you to change up some things in your own practice.
Yeah, it's feedback. A review is a feedback. It's good
That's right.
also to answer to those bad reviews because it
Mm,
shows that you care and you intend to do better. Or sometimes there is some misunderstanding or misinterpretation. Also, having no review to not get good to only have good review is not a good idea
mm,
either. They should request for a review, with every client because it builds
mm,
the credibility and the perception. Um, from the outside world, it just gives a better perception for buyer
mm.
also when they will do their digital due diligence, which I did when I was looking to buy that agency. And I'm still looking, and when I look at businesses, the first things that I look is their digital, like with what they build, is it, realistic to assume that they are generating leads from online, or like is it systematized or not, or actually is everything a referral? Does everything depend from the owner?
I really appreciate this point, Muriel, because you know what? On the same topic that we were just talking about on building a veterinary practice that buyers can trust, and it's not just about the revenue, right? It's also about how it's structured, visible, and scalable the practice looks from the outside. So this is where marketing, as you mentioned, becomes very important. A strong digital presence, clear patient acquisition systems, strong online reputation like this my Google My Business profiles, and consistent communications overall all contribute to how your veterinary clinic is being perceived, not just by pet owners, but also, as Muriel mentioned, by auditors and potential buyers. So for our veterinary practice owners listening in, who want to understand where they currently stand, the Veterinary Business Institute, in partnership with Echo Marketing, offers a marketing strategy meeting. Now, this is a focused marketing strategy. This is a focused marketing strategy session designed to review your clinic's current digital presence, identify gaps, and uncover opportunities to strengthen growth and, of course, long-term practice value. This session is led by Lila, a veteran in veterinary marketing who has conducted audits for over 200 veterinary clinics and helped them improve their online presence. Now, her experience gives practice owner a practical, clinic specific view of what is working, what may be holding growth back, and of course, what can be improved across areas like website performance, online visibility, reviews, patient acquisition, the whole lot on digital marketing systems. So go ahead and take the next step. Veterinary practice owners can book a session with Lila at veterinarybusinessinstitute.com/MSM. I'll repeat that one more time. Veterinary Business Institute, that's one word, .com/MSM, and get a clearer expert-backed roadmap for strengthening your clinic's market position, digital presence, and of course, future value. That being said, let's get back into our conversation here. So Muriel, what are some of the simple steps veterinary practice owners can take in the next 6 to 12 months to make their clinic more attractive to buyers?
Yes, I will start with documented as much as they can. See how to automate the client meetings, online, how to have less founder dependency on sales, so systemize that, and add a bit of my note that I could be checking now. No, and track everything. Start to track, for example, the retention rate by client, how much revenue, because all those things are going to be asked by a buyer. And it's good for yourself to know, like, your customer concentration. If you realize you have some clients that represent 10% or more of your revenue, or even an acquisition channel that you're too dependent on one acquisition channel, look to diversify that, so it will give more confidence to a founder. I went a bit, I went more in depth into all of that in the future book that will be released on July 27. I wrote the valuation gap, what buyer sees that seller miss, and everything is explained to actually close that gap from, like the valuation you would want to the valuation that the buyer will pay. Because trust me, as buyer, and I am part of a buying community with a lot of other buyer, and can say it up straight, we don't mind paying a lot for a good business, but the business seems to need to be solid, transferable. If I am sure that the cash flow will be mine once the transfer, once we go to the finish line and we transfer, then I don't mind paying more for that. If it's a business, I will have to document everything myself. I will have to be, becoming the previous founder to keep the relationship, to retain the employee, to, everything. Not only I don't want to buy a business like that, But also, if I do, it will be so discounted.
Ooh.
And often I see actually those type of practice when we look at, biz buy sell and other, websites to buy a business. I often see that the medical practice tend to be, have a lower multiple. I've noticed that, like with dentist office at some point, because there's maybe just one or two person there, and it's heavily founder dependent. Heavily.
Right. And then okay, now I'm curious about this. You mentioned, a lot of those practices that are heavily founder dependent are, heavily discounted as well. I mean, that's unfortunate, especially when you mention for a good practice with strong cash flow, the right price can be paid. And, that's what everyone really wants, right? When you're looking for an exit. So if we are on the other side, on, when we're looking at our practice and it's not getting that valuation it deserves, as a final key takeaway from this conversation, what would you tell our listeners? Where can they start? And what is the main thing that they should really look into to fixing that, to turning it around to that high value practice?
Yeah, they should try to step out for a couple of days and see what breaks first and then fix it. That will be my takeaway. If, for example, all the appointment with the client cannot be honored because it was the one supposed to be there, but that means you need to bring someone in. If the team was stuck with a decision, didn't know what to do, okay, document everything. If there is no more, it was the one, I don't know, picking up the phone to book every appointment. Oh, so there is no more appointment. Okay, solve that as soon as possible. Either get an assistant to pick up the phone to book appointment or make the appointment available online. But just like step out of the business for a couple of days and see what happened. So you can fix it.
Amazing. Well, that was a powerful look at building practice value and transferability with Muriel Touati. If you've been struggling with the feeling that your clinic is entirely dependent on your personal presence, well, we really hope that this conversation gave you the frameworks to rethink your operational and marketing systems. Mastering owner independence isn't just a management goal, it's the ultimate driver of your practice's final sale price and, of course, your own personal freedom. Now, if Muriel's approach to exit readiness resonated with you, we highly recommend connecting with her and exploring her work at Exit 3D Studio, where she acts as the strategic architect for owners ready to scale and eventually transition on their own terms. Now, a quick reminder, if you want to better understand how your practice shows up online and where your marketing may be holding back your growth, you can book a complimentary marketing strategy meeting with Lila through the Veterinary Business Institute in partnership with Echo Marketing. You can book your session at veterinarybusinessinstitute.com/MSM. That being said, I'm Adeesha, and this has been the Veterinary Business Podcast. We'll see you on the next one. Take care, everyone.